Morning all. I can see the participant numbers ticking up now, so we'll just give people another moment or two to get set before we kick off. Well, the number of participants seems to have stabilised there, so I think that's probably a good time to get started. So good morning, everyone, and thank you for joining us today for this webinar where Portfolio Manager Bob Liu, who joins me on screen, and I will provide an update on the listed private equity markets and an update on the Barwon Global listed private equity fund. We're thrilled to also be joined today by Ryan Faulkingham, who's the Chief Financial Officer of Compass Diversified Holdings. Compass Diversified, which we hold in our fund, is a US listed private equity vehicle with a portfolio of US middle market, consumer and industrial companies. After the update on the fund and the markets, we'll get stuck into a conversation with Ryan. Now, I'd encourage you to ask questions today through the Zoom webinar portal, and we'll get to them in the Q&A session later in the webinar. Now, hopefully most of you on today's call are reasonably familiar with Barwon, but to provide a quick update on the firm and introduction to those who are new to Barwon, we're a Sydney-based investment management firm with a focus on alternative assets. We have a team of 43 people and manage a total of $2.3 billion of assets across three broad strategies, being healthcare property, property finance, and private equity. Our clients include large Australian and international superannuation funds and pension funds, family offices, high net worth individuals, and wealth management groups. Hopefully, most of you have some familiarity with our listed private equity strategy, but for a quick recap, the key objective is to provide investors with liquid exposure to the private equity asset class and the private equity return premium over the cycle by investing in listed private equity securities. The Barwon Global Listed Private Equity Fund was launched as a wholesale unit trust 15 years ago, and 2 years ago, we launched a retail feeder to that strategy, which is now available on all the major platforms and has been rated by both Lonsec and Zenith. We also offer access to this strategy to our European clients through a UCITS fund, which mirrors the portfolio of our Australian unit trust. Now, noting that the objective of the strategy is to provide that private equity return premium, but with the benefit of daily unit pricing and daily liquidity. This strategy allows investors to access the private equity asset class with a very small investment minimum, with daily pricing and providing immediate exposure to a diversified portfolio of private equity assets across sector, region, and vintage. Now, the fund has also delivered on that objective of providing that private equity return premium over the cycle, having delivered 14.9% per annum over the last decade. Give a brief update on performance. You can now see the fund's performance over various time periods on screen. And for me, this chart highlights two key points. And something we want to be very open about, and we talk openly with clients about, is that the price investors pay for that daily access to the asset class is that there is a level of equity market correlation and volatility in this strategy, as highlighted by the softer performance year to date as equity markets have sold off. However, the second point, and this is demonstrated over the longer return timelines, is that the fund has delivered on its objective of providing that private equity return premium over longer time periods, outperforming the MSCI All Cap World Small Cap Local Index by over 400 basis points per annum over the last decade. Now, before I hand over to Bob to talk through listed private equity markets, I'll give a brief update on portfolio positioning. Many will know that we break the investable universe down into four segments, being buyouts, which is really that core equity position in private equity buyout transactions, private equity backed public companies, listed private debt vehicles, and alternative asset managers, the managers of these private equity deals, so getting a share of that management fee stream. Now, over the last year, our exposure to the buyout segment has increased, and combined with private equity-backed public companies, makes up over half of the total portfolio. We've substantially reduced our exposure to listed private debt funds, primarily on valuation grounds, and Bob will provide a bit more colour on that part of the market shortly. Our exposure to alternative asset managers has remained broadly steady at around 30% of the portfolio. We're also carrying a slightly elevated level of cash at around 10% as we've reduced those listed private debt positions. Now, in the middle chart, you can see the vintage exposure. On the vintage front, the portfolio remains very nicely diversified across the last 6 or 7 years of vintages, indicating there should be a good amount of embedded value built into these portfolios. So with that, I'll hand over to Bob, who'll provide some context on recent private equity results and the outlook in the market.
Great, thank you, James, and thank you everyone for joining us today. As James mentioned in the fund return update, we've had a volatile start to the year. On average, the discount to NAV on which listed private equity funds trade is about 30% today. And that's widened from about 15% at the start of the year, shown in the chart by the lighter squiggly blue line. Note, this is an average sector discount. Our portfolio holdings actually range from a 10% premium to over a 40% discount. As many on the call would know, we're not discount-focused investors, but I think it's interesting to put the current market into historical context. This is the widest discount the listed private equity sector has traded on, excluding the COVID period, since about 2013. But the real question is a discount to what? We're in the middle of reporting season. Half the NAVs are updated for 31 March and the other half remain at 31 December. So noting that most run on a quarterly valuation cycle. Q1 NAVs reported to date have been much more resilient than expected. Private equity NAVs for the first quarter have ranged from being down 3% to up 8% over the period, ahead of public equities, which were down about 6% over the period. Declining valuation multiples have clearly been the headwind this quarter. And this has been most acute for richly valued, high growth businesses, but with low or no current profitability. The drag on performance from valuation multiples, however, is being offset by positive earnings growth. Most businesses are coming off a record year for earnings in 2021. The graph here shows the trailing 12-month earnings growth for the underlying portfolios of our listed buyout investments, all of which are very healthy. And it's not just a 2020 COVID impacted base effect either. Most of our underlying portfolio companies are trading above 2019 level earnings. And this has been driven by a strong consumer with a lot of savings, tight labor market and upwards wage pressure, and a generally healthy business investment environment. There are, however, recent signs that cost inflation, logistics challenges, and a softening consumer sentiment are really starting to bite and place some pressure on margins. The impact is, of course, different across companies. Some are able to pass on these costs better than others, but growth is still very much positive generally, and we've been encouraged by the trading updates year to date thus far. And it is earnings growth that is ultimately the biggest driver of PE returns. Simplistically, if a business can grow earnings at 20% per annum over 5 years, you can make 3.5 times money on equity, all else equal. If over that period, valuation multiples were to decline by 25%, your return is still 2.5 times money over 5 years. So our focus has always been on quality private equity sponsors and companies able to really deliver on that revenue and earnings growth. Ultimately, good returns can be generated even in a challenging valuation environment. Our fund also invests in listed private debt funds. They predominantly make loans financing the private equity buyouts themselves. So in these investments, you get an attractive running yield, and they're more defensive as you're higher up in the capital structure. So as you can see from the chart, the sector saw an average 14% decline in NAVs back in March 2020. Most of this was due to unrealized mark-to-market losses on their loan books. Since then, we've seen 7 consecutive quarters of recovery in loan values as rates of credit default remained extremely low. However, in the first quarter of this year, book values have actually declined by 0.4%, the first negative quarter we've seen since March 2020. The volatility we've seen in public markets has meant new loan activity and private equity deal activity has had a slower start to the year. Credit stress still remains very low, and they're coming off a base of essentially, while credit stress remains very low, they're coming off a base of essentially 0 non-performing loans. So we're just starting to see this quarter, 1 or 2 assets get into trouble in each portfolio. This next chart maps the price to book value on which the listed private debt funds trade. Again, in March 2020, the sector traded out to a 60% discount at its depth. These were absolutely distressed valuations at the time, and our fund increased its allocation to this sector to almost 30% of the fund. Since then, the sector's recovered in terms of both book value and, as you can see, valuation rating as well. And performance this year has been resilient. The vast majority of their loans are floating rate credit, so additional interest rate rises will translate into higher investment income, at least in the short term. From a valuation standpoint, we believe the sector's trading just above book value, slightly above its long-term average. We think the market is hoping that the sector remains in this Goldilocks setting. And this setting is where your floating rate credits pay off from higher interest rates, but interest rates don't rise so much as to cause offsetting credit losses. As we've seen in past rising rate cycles, it's not as simple a translation as higher rates means higher earnings. In saying that, as a sector, we think it continues to offer attractive defensive income of 8%, with potential for some dividend upside. However, we remain selective here. We've taken further profits from this sector this year, as James mentioned, and so the fund has a low 5% allocation at the moment. With the sector trading at a slight premium to book value, we typically want to see greater potential for valuation re-rating upwards to meet the target return for this fund. And so we expect there to be select opportunities to redeploy capital in this space, like we did through 2020 when appropriate. So moving on to the alternative asset managers, which is about 30% of the fund. Many of you will appreciate the extraordinary growth in alternative assets in the investment world. There's been an accelerated decade-long shift in institutional portfolio allocations towards alternatives. More recently, the big growth area has been private wealth management and independent advisor channels, which are rapidly catching up to institutional levels of allocation. The biggest beneficiaries of investment in terms of investment management have been the large established players. Blackstone has gone from 166 billion 10 years ago to over $900 billion today in AUM. KKR has gone from 60 billion to almost 500 billion. And it's not just private equity. They've really broadened into alternative asset platforms with private credit, real estate, and infrastructure capabilities. The organic growth has been incredible. They've been raising larger funds more frequently and growing into adjacent strategies. As an example, 4 years ago, Blackstone launched an Asia-only private equity buyout fund alongside their long-running global strategy. Just recently, they closed their second Asia buyout fund at $11 billion in committed capital. Which really shows to us how quickly platforms can scale. But the growth hasn't been all organic. In 2021, we actually saw a record number of acquisitions of smaller alternative asset managers. Some of this has been traditional asset managers wanting to grow into private markets. So T. Rowe Price, in their first acquisition in over 10 years, recently bought Oak Hill, a private credit manager with over 52 billion in AUM. The listed alternative asset managers have also been very active on the acquisition front too, acquiring both new investment capability and expanding geographic presence. Ares Management, for example, which started out in private credit, really being a direct lending specialist, acquired AMP's infrastructure debt platform in Australia recently, and has also expanded into secondaries by acquiring one of the oldest and largest secondary specialist Landmark Partners. The valuation environment for the alternative asset managers, to me, is reminiscent of the sector 5 years ago. I think it's trading very cheaply. The market's currently attributing almost no value to the potential for future carried interest or performance fees. And at the same time, valuing a highly visible and growing management fee earning stream at a multiple far lower than the broader market. Today, these names, these large platforms, these large alternative asset managers are far stronger businesses than they were 5 years ago. They've got strong fundraising trends across multiple distribution channels, both institutional and retail, and across a diversified set of strategies. So they're far less dependent on the success of any one strategy or fund vintage. And they have good visibility to management fee earnings growth of about 15 to 25% per annum. So to sum up, we're pleased with the NAV performance of the fund's investments. Over the past 2 years, we've really used the volatility to rotate the portfolio into high quality managers and private equity portfolios at attractive entry prices. What we've avoided is the deep value, more liquid and challenged situations, which often present as tempting value in times of market strength. We're very focused on liquidity at both the underlying company level and at the LP holding company level. Much of the portfolio has been busy locking in cheap financing over the past 18 months. So liquidity, in many cases, is better than what it was pre-COVID. We currently have a low allocation to listed private debt funds. We still offer a good defensive yield, but we remain ready to redeploy into this sector selectively. And our preference has been for the large established managers over the perhaps higher growth, but smaller alternative asset managers with much greater single fund or strategy risk. The alternative asset managers have a lot of capital to deploy, and they've made some great investments through past periods of volatility, and we hope that they do the same this time also. So that wraps up the fund update, and I am very excited and pleased to introduce our guest speaker, Ryan Faulkingham, CFO of Compass Diversified. So Compass Diversified, or CODI for short, is a NASDAQ-listed private equity stock with a market cap of about $1.7 billion. They acquire mid-sized American branded consumer and industrial businesses. They currently have 9 investments shown on the left, and we've also presented 3 examples of past investments on the right. So Ryan joins me from their base in Connecticut late in their evening, so we're very appreciative of him giving us his evening today. Welcome, Ryan.
Thank you, Bob. It's an honor to be here, and the sun has not quite set here, so it still feels early in the evening.
Terrific. Perhaps to kick things off, Ryan, US middle market private equity buyouts, it's a competitive space. Tell us about CODI's approach to investing and owning businesses. After you acquire a business, what do you do with it?
Sure. Yeah, sure. So, looking at your slides that you just had put up, Bob, and the amount of AUM that's moving into, these asset classes, and in particular private equity, as people, chase yield out the curve, is really historic. So, we've always had to try to figure out, how can Compass be unique in this environment with such competition for assets? And really, our competitive advantage, we felt, has always been in our structure. And it's something that, dates back from our public offering back in 2006, in which, we prior to going public, we had really a family office structure, which had really long-term patient capital, and it really framed our investment philosophy. So as we considered our options in 2006, raising a traditional private equity, multi-fund type strategy was an option for us because we had really solid IRRs for sole sponsor. But what we realize is that traditional private equity, did not align with our investment philosophy, and specifically it has to do with the timeline, in that, traditional private equity, given its structure where, they receive capital that they need to put to work within a period of time. And if they don't, they have to return it back to LPs, that creates pressure to deploy capital. And when you have, large institutions giving money to private equity, they don't want private equity to sit on cash, right? The allocators, they'll sit on their cash. They want you to put your money to work. That creates pressure to deploy. And, the beauty of our structure is that we don't face those pressures to deploy because we have permanent capital. In this public structure, all of our shareholders are control equity owners in the businesses that we own, and allows us to be much more patient when we move into investments, and also on the back end when we harvest. Because if a private equity firm is new, they need to sell a company to put up a scoreboard, right? In order to go raise fund two. We don't have multi-funds, we have one fund. And if it makes sense to make long-term strategic investments in our businesses that might not pay off for 5, 8, maybe 12 years, that's okay. We'll make those investments because we believe in the management team, we believe on that return on invested capital, and that's the strategy which we think wins. So that's a fundamental competitive advantage that we think we offer in this competitive market. And number two, it's always been our cost of capital, in that we are raising our capital at the parent level at Compass Diversified Holdings. We are funding both equity and debt in each of our companies, and that's important. One, because all of the cash stays in our system because we're their banks. We don't get third-party financing at each subsidiary level. We are their bank. And further, it also is a competitive advantage because we get much lower cost of capital than our private equity peers, right? I was just on a call with Bank of America thinking about our capital structure, and we can go get a term A loan today, pay L plus 225 in today's market, or SOFR, whatever the new metric is, which is roughly 3.5%. Their individual company sponsored debt deals right now are 12.5%. That's a significant competitive advantage when you're going to market and looking at deals where we can create and buy A+ businesses for high valuations. Bo is a good example. We paid 15 times for that business, and yet it was still accretive in the near term. So I think those are what the competitive advantages we provide in our structure against that competition you referenced. Great,
fantastic. And you mentioned the cheap financing that has been available, and we've been in this low interest rate environment now for a couple of years. Can you maybe explore a little bit further how your financing has changed over the past 2 years, and what that means for investors?
Yeah, absolutely. Part of what has made Compass, obviously a great place to work is its uniqueness. And, that is both good and bad. Good in that we're a one of one and don't really have true competitors that are structured exactly like us. But that's also a challenge because whenever we enter new markets, it takes time to season, because they say, who's CODI? They're kind of a different structure. We don't know of anybody exactly structured like them. But once we seed in that market, then people really see the value that we're bringing in this model. And a good example is on, the debt side. When we first went public, we were a unique capital base that would be leveraged. Traditionally, banks were used to asset-based lending. Here we had really enterprise value-based lending. And that took some time for banks to understand. So, getting into the revolver market, getting into the term loan market took time. And it was, unfortunately, we had to pay a hefty cost to get into those markets. Fast forward to 2018, which we think was a game-changing event for our capital structure, is that we issued our first bond. And we got into the unsecured bond market, which we love because given that long tenor, 8 or 10-year type bond tenor, that really aligns well with our investment philosophy. Now that was at 8%. So again, talk about seasoning in the market. Fast forward to March 2021, we were able to refinance that down to 5%. So we have $1 billion of 5% unsecured bond at 8 years, fixed, right? Then in November of 2021, just this past year, we issued another $300 million on the heel of an acquisition that was 10-year paper fixed at 5%. So we have no floating rate debt today. It's all fixed, and we have no interest rate exposure. So it's a really great balance sheet position to be in. But that, that didn't happen overnight. There's been, 14, 15, 16 now years of performance and quote unquote seasoning in the markets for us to get there. But now we feel like we've got the balance sheet that we can be, that competitive advantage I've been talking about, we always thought should exist. It's just taken a long time to get there. We now have a very strong balance sheet, a cost of capital lower than our competitors, and it provides us the ability to move when others can't. And I think that that's where CODI has shined in the past. A good example is in 2020, in the face of the pandemic. There were no private equity deals going on. We saw the market opportunity to buy two premium brands, Marucci, which is a baseball and softball equipment manufacturer based in the US, and BOA, which is a premium performance lace replacement system for athletic shoes. And those two deals we would not have gotten absent the pandemic. Now, why could we move? Because we have permanent capital. We don't have to go get deal by deal financing. We borrow at the holdco level, don't have to ever ask for that capital. We can take it when we need it and move on two great businesses. And now you've seen, tremendous results out of both those companies since then. We now are in a similar environment, in our opinion. We're seeing dislocations in the market. We're seeing it's difficult to get funding, difficult to make transactions and raise capital from a private equity standpoint. We have a strong balance sheet. We have permanent capital. We feel like our competitive advantage should shine this year again. Because frankly, last year, it didn't, right? When everybody's got money, everybody's got capital, that competitive advantage of having permanent capital, it's not there. But it's really when the markets dislocate that it's there. So we think we're entering that today. So we're pretty excited about what might transpire over the last 6 months of this year. Now, notwithstanding the pain everybody is seeing on their screens with the stock market down, but that's typically when we can zig when others are zagging and produce some really outsized strong returns.
Fantastic. And I think it'd be really interesting to bring to some of the portfolio companies to life. I think got a really interesting set of investments. One of your most recent deals, as you mentioned, and now I believe one of your largest investments as well in the portfolio is BOA. Can you talk a bit about the background to the deal, how it was closing a deal in the middle of the pandemic when it first broke out, and how it's fared?
Sure, absolutely. Yeah, no, BOA is has been a tremendous company under our ownership. Probably one of the best, maybe the best business we've ever seen, maybe ever will see. It's that good. And just to give you some context, it's a business that has penetration in its addressable market of sub 5%, has 40% EBITDA margins. It's growing, 70, 80% top line year over year. And it's got IP that protects its business tremendously. So and by the way, it's got negative working capital. So it's just a tremendous a business. But how did that business come along? It was, again, unique. Every one of these deals is unique. And the BOA is a good example where the owner of BOA at the time was an individual in his 80s. He was, not of good health. And he launched the deal in late 2019, and then the pandemic hit. Then they paused the deal. We love the asset. We didn't think we had a chance at buying it. The early whispers were that BOA would trade for 600 million plus. And we knew that was not something we were willing to take, from a risk standpoint at the time. But then the pandemic hit. And then that individual did not want to wait for the pandemic to end because nobody knew when that was going to be. And he knew that the earnings would be down in 2020, but he didn't want to wait until 2021 for it to show recovered earnings. So he wanted to move on the transaction. We knew the banker really well. We said, what's the price that this gentleman wants to transact at? And the number was 450. So we went for 450, which was 15 times. The business was doing 30 million of EBITDA at the time. So we paid 15 times, which is the highest multiple we've ever paid for the business. At the time, we believed it was an A+ business. Fast forward to today, it's an A++ business. It has exceeded our expectations beyond belief. And just to give you context to that, in the first quarter of 2022, the business did 25 million of EBITDA. And in all of 2019, it did 30 million of EBITDA. In all of 2020, it did 30 million of EBITDA. And the trailing 12-month right now is north of 70. So it's been just an explosive growth opportunity. And what did we like about the business? I talked about the financial profile, but one thing that the business was just about to prove right after our ownership, which is we knew was sort of the next leg of its performance, was that their dial-based system that goes on snowboard boots, workwear, golf shoes, trail running shoes, bike shoes, you name it, provides true performance enhancements in both agility and speed. They were doing a white paper through the University of Denver that then was published, peer reviewed, and then sent out to the public to say, BOA with their Y-Wrap system on shoes produces a 4 to 9% improvement in speed and agility. And when you think about top athletes, how big 4 to 9% is, it's incredible. So what we're now able to do is go to our brand partners and say, if you want to produce the best trail running shoe in the market, you need BOA. Here's why. Here's the paper that proves it. And Adidas and Saucony and all these companies say, wow, we want to be the best. And you're right. Having that wrap around the top of the foot, the pull-in of the sole and the heel while leaving that toe box open truly changes the experience and the performance of that athlete. So now think about the opportunity of that across so many different channels, so many different markets that we're not even in. We're not in court sports. We just launched our first shoe in basketball. It was Dwayne Wade's shoe in China, sold out, within days, had 2 dials on it. So, I mean, we are just entering markets for this business. To talk about the total addressable market, when we did our analysis upon acquisition, when we looked at the price points that we sit, which are premium, we are premium shoes, right? We're not on a $80 trail running shoe. We're at a $200 or $250 or $300 trail running shoe. So just in the price lanes we live in, there's about a 800 million shoe opportunity per year, and we're sub 5% of that. So you think about the TAM here, it's, massive. And some of the opportunity, when you think about snowboarding at the price points that we operate in, we have over 70% market share. So when you think about what this dial has done to the snowboarding experience, that's what the opportunity here is. Bike, when you think about bike shoes on whether it's road or mountain, we're north of 50% market share. Golf is going to move to that same direction. And we just entered trail running. We just launched a badminton shoe in China. I mean, there's just sort of endless markets and opportunity here. We also are launching this winter our first alpine downhill ski option, which will have 1 dial on the base of the boot. We're working with 3 of the premium downhill brands. So it's just a tremendous business. And then when you think about the fact that it has 160 IP, patents around its technology, utility patents, there's really no other competitors that can even come into this market. And when they do, we don't even need to press on the legal pedal, because when we find a competitor, and they're always out of China, working with one of our retail partners, let's say it's, Fila, for lack of a better brand, we simply call Fila and say, by the way, this shoe you're working on with that company, they are infringing upon our patents. You're going to have to pull all those shoes off the market. And they say, they go away, they come back a couple of days later and say, yeah, you're right. We need to eliminate them and move them off. So we can, pressure our IP portfolio without having to spend a lot of money on it, which shows the power of the IP portfolio, the brand, and the technology.
Right, because the brand are really leveraging the brand are really leveraging the BOA lace, and so you can and so they're interested in protecting their own market share there.
That's right. That's exactly right. And as we think about long term, what will drive this business, of course, will be continued adoption in other product categories, as well as similar product categories, but extensions of products with existing brand partners. But it's also that there's true performance enhancement with having 2 dials versus 1. Dials are getting bigger, getting more powerful. You need bigger dials on snow boots. We're launching 1, 2, and 3 dial options with our brand partners. So, as they get bigger and more stout, there's higher price points that we'll be able to achieve. And then, one of the other fascinating parts of the business too is when we think about the supply chain risk that companies are facing today, BOA, all these dials are manufactured in China and then delivered in China to the brand partners manufacturer of their shoe, right? Adidas doesn't make their shoes. They outsource their shoe manufacturing. So our China-based manufacturing product is being shipped to other China locations. So it's really not faced much of a supply chain, shipment issue. There's certainly been some closures and shutdowns in certain facilities here and there that we've managed through. But by and large, the 95 days of inventory that some of our consumer brands are facing, which used to be 40 days, BOA is not facing that, which is another, great aspect of the business.
Yeah, that's fascinating. I think that example of delivering your products to the next stage of the product manufacture cycle, I think is a great one for BOA. But obviously, you have a number of different consumer brands. I mean, can you talk a little bit more about the broader experience of the supply chain bottlenecks that you're experiencing and the impact they're having on businesses?
Yeah, absolutely. No, it has certainly been a incredibly difficult environment for our management teams to manage through. And yet I feel like that's a broken record because we just came out of the pandemic, which we thought was also a tremendously difficult environment to manage through. But our management teams are doing a tremendous job. In some cases, Marucci's a good example, this baseball bat company. It is the fastest growing brand in baseball in the United States. More than 50% of Major League Baseball players are swinging, Marucci or our sister brand Victus. So it's a great growth company. We are taking market share. We are expanding store, footprint and shelf space at some of our key retailers. But coming into the 2022 season, we had to make sure we had product there. So we had to air freight it. There was no way around it. We had to get product to our, to our core customers, and that came at a price. So we saw good revenue growth at Marucci because they continue to see strong demand levels. But that we took a hit on margin by having to air freight product in, but we knew strategically it was the right decision for the business long term, and we have the balance sheet to do that. That's the beauty of this model too, is that we can support our companies through economic downturns, whereas other private equity firms may not have the access to capital like we can, and may not be able to press on the inventory, pedal like we've had to and like we've wanted to. Another example is 511 and Ergo too faced in January the worst inventory receipts month in their histories. Just to give you context, 511 received only 25% of the product they expected in the month of January. Now that got better in February and got better in March. So they were able to close out the corner, with good performance. But boy, it was, scary for a little while. So, we've had to invest in inventory because the demand's there for these great brands. Ergo Baby makes soft structured baby carriers. 511 is a premium brand in the first responder space. So think EMS, firefighters, police, that product is in high demand and it's the premium product, premium price point, but people wanted product, people needed product. We were out of stock out of certain sizes. So, that pressured our first quarter results. But like I said, it got better in March. Now, April has been okay, not as good as March. So I think when you hear that, oh, we're past the supply chain problems, we don't think that's the case. We think they still exist. There's still a lot of inventory in the system. And, look, there's another threat to the United States with a potential port strike, in California, with a longshoreman, and that is a real risk. And I'll tell you, coming out of all of our board meetings with our subsidiaries to a tune, every single executive who has exposure at that port said they think there's going to be a strike. So there's going to be another wave of pain here. And again, with our balance sheet strength, our cash on our balance sheet and our capital will support our businesses through this because we've got to have product to see demand. And that helped, frankly, put up what you guys saw as our record first quarter results, given that strategic decision on inventory.
Mm.
And there's also, Ryan, been a lot of talk about inflation of raw material prices, of labor. which of your businesses are experienced perhaps the most pain and which are able to offset it?
Yeah, sure. So it is definitely a challenge for a lot of companies and businesses, with certain commodity exposure are surely, feeling the worst pain. Altor is a good example of that. They do custom molded foam products for packaging. So not block, not basic foam. This is truly you're spec'd in as part of the manufacturing process, as part of packaging, that important product to be shipped. And EPS, which is expanded polystyrene, is their core component. It's derived from it's an oil-based, derived product. So we've seen, huge price increases. That was beginning of 2020, late 19, a 31 cent per pound product. That's now $1.31. So, that's a real pressure this business faces. Now, one of the things we liked about this business, and one of the reasons we bought it, is about 80 to 90% of their contracts with their customers have escalating clauses contractually in there. So every quarter, based on an index, we can raise prices. Now, the problem is there's a lag, right? So you see a big steep price increases in the first quarter of 2022. We can't pass those prices on until April of 2022. So we've seen margin compression. Now, we know that once prices stabilize, margins will return to more normalized levels. And in fact, if and when prices come back down, that's when we see margin expansion, because we don't have to pass through the price declines until a lag. So, that business has handled it reasonably well. Sterno is another example of the type of company we like to buy, because they do canned heat, which is diethylene glycol, that blue gel you see, cooking buffet trays, which, as you can imagine, during COVID had really, depressed results. But the business has really come back really nicely this year. And by the way, in the face of Sterno's, poor performance, we've had other companies that, really shine. So, the beauty of a diverse group of companies is that we were able to still grow our EBITDA on a pro forma basis through the pandemic. But notwithstanding that, Sterno faced some pressure during the pandemic, but coming out of it, started to see price increases on some of their core components like diethylene glycol. They also make the wire racks that you put those trays in. They were seeing 30, 40, 50% price increases. But again, one of the reasons we love Sterno and we focus on niche businesses is if they're a niche business, they've got to be the market leader, because they will command pricing, and Sterno does. They are 70 to 80% of the canned heat market. So when Cisco or Aramark or US Foods, big food distributors need 100,000 of canned heats, per week for 17 weeks, there's only one company that can provide it, and that's Sterno. So that's a niche market leader. And by the way, we're able to then pass prices on, right? So we have done a tremendous job throughout the last year, and even in the first part of 2022, raising prices. So Sterno, even though we think, overall food service may decline from pre-pandemic levels, it might be a smaller market. They have higher pricing. So we think top line can exceed even pre-pandemic, just given some of the structural changes in pricing. So, that's a little bit about how the industrial businesses have fared. I think some of our other companies like BOA hasn't really faced a significant increase. Marucci has able to really, they've got wood bats that are sustainably harvested in the US. It's our trees. We don't have to worry about supply chain risk. There was some pressure on aluminum pricing, but we buy out really long. So we didn't see, a huge pressure there. And, both those brands are able to raise prices. So I think it's really hasn't been a tremendous pain point on our consumer brands. And I think you guys know this too, as you think about private equity firms with consumer brands. If you truly are a leading brand, you should be able to raise prices. And all of our brands have been raising prices, and they have been successfully raising prices. And look, it took our management teams a little pushing for them to get there, because they've been for the last decade in a deflationary environment and not had to worry about it. We were pushing them in 2019 to think about beginning to raise prices. So we were ahead of it in a lot of cases. So we've been able to preserve margins. If you looked at our first quarter, our EBITDA margins were down about 100 basis points, which, considering all those headwinds, we think was pretty remarkable, coming out at 20% EBITDA margins across the consolidated group of companies.
Sure, yeah. Very strong result, all things considered. Just in the interest of time, we might sort of start moving towards audience Q&A. And so anyone on the webinar, I encourage you to post your questions in the Q&A box. And just the first one that's come through, I think it's quite a good one, considering your comments earlier about your capital structure and the permanent capital nature. Is, given the permanent capital nature, how do you decide when to sell a company?
Yeah, no, it's a great question, and it's one where in our minds it comes down to what creates the most amount of shareholder return at that decision point. So if we get, an offer for a business, let's say a business that we think is valued at 300, we get an offer for 375, and we say, wow, that's a decent return, but we think that this business has the opportunity to be worth 500 or 600 one day. It might take some capital, but we believe in the management team. We believe in the runway for this business. We think holding it's going to create more long-term shareholder value. So it's really a case-by-case decision we'll make. Another example is we had Camelback. It's one of our past investments, and Vista Outdoor, a very sizable, large public company in the United States, which had a core business in ammunition, wanted to get into the outdoor product market. And the top brand on their list was Camelback. They wanted that business. They came to us and they said, we're willing to offer you Y. We said, no chance. They came back at Y plus a lot more. And we said, okay, now we'll talk. And they bought that business at what at the time was like 16 or 17 times cash flow. So a really tremendous outcome for a business that we paid 8 times for and was growing about 3 or 4% a year. So same thing with the Manitoba Harvest business, which was a protein-based, food company that was bought by Tilray, which was a, marijuana company based in Canada that wanted our business because we were a hemp seed business and paid us 55 times EBITDA for that company. We didn't have any desire to sell it, but we said, wow, from a shareholder return standpoint, that's going to far exceed our ability to drive value through execution over the next 5 or 10 years. So we took that. So it's really case by case, James.
For sure. No, very helpful. This one's probably more for me or Bob. And what is our exposure, Barwon's exposure to venture capital investments? Bob, do you want to take that one? Do you want me to take that one?
James, why don't you take that one?
Yeah, look, we have with the Barwon Global Listed Private Equity Fund, we have one investment which is dedicated to growth investments, or what are often described as crossover investments. So investing late stage growth businesses. It's not so much the really early stage stuff, but it has certainly been impacted in the last 6 months, and that represents about 5% of our portfolio, that individual stock. Then across the broader buyout portfolio of buyouts, there's another very small exposure across a couple of the managers we're invested in, but really at a portfolio level, that beyond that single stock, it's a very small weight. So I'd say 6 or 7% total of our portfolio would have that sort of exposure. One question, another one for Bob. Can you please confirm, is it the alternative asset managers that have been the bigger contribution to volatility or negative performance this year?
It absolutely has been the alternative asset managers that have had an outsized contribution to volatility, if you will. Again, despite their stable management fee earnings, which aren't affected by public equity movements, their share prices, unfortunately, and we've seen this through past periods of market dislocation as well, are more volatile than we think their fundamentals reflect. So indeed, the rest of the portfolio has performed, has been perhaps less volatile than the market, but the alternative asset managers have been more volatile than the broader market.
Right. Well, one interesting question here, actually. What's your view on the increasing use of co-investments among the London-listed buyout funds?
I'll take that one. Look, I think it's not just we've certainly seen a number of the London listed private equity funds who traditionally invested via commitments to private equity funds, really increase their allocation to individual co-investments. And I don't think they're unique. We've seen a lot of limited partners and private equity investors increase that co-investment allocation. It's partly being fee driven. So if you're an investor, if you make a commitment to a manager's private equity fund, some co-investments will be offered on usually a fee-free basis, and so it's a way to lower the overall expense ratio. I think it really. So you can see why investors do it. I think it really comes down to a question of expertise, and whether the manager has well, firstly the right degree of deal flow through their private equity fund manager relationships, but also whether they're adequately resourced to be able to do the due diligence and to be able to transact on the co-investments where you are taking that more concentrated risk in a single asset.
No, good answer, Bob. And look, in the interest of time, I think we might wrap it up there. So finally, I'd just like to say once again, huge thank you to Ryan for joining us. Well, it's been a really interesting conversation about Compass Diversified, about the US consumer markets in which you're investing. And I can see the sun has nearly set there. So thanks for your time. Now, to everyone on the webinar, thank you for your time and joining us today. If you have any questions that have come out of the webinar today, please do get in touch with us. You can see a number of contacts on screen there, or reach out to your regular Barwon contact. So once again, thank you all, and we look forward to talking again soon.
Thanks, James. Thanks, Bob.
Thanks, everyone.
Have a great day.